morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Peter Hodson, Chief Investment Officer at I2I Capital Management, is our guest co-host. AI competition is heating up. Peter will help us break it all down. And we want to hear from you, of course. On First Call, call us with your questions on North American mid-caps, and we'll have Peter answer as many of them as he can. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Also, our email address is firstcall@bellmedia.ca. Now, here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Multiple reports suggest Ottawa and Alberta have agreed to the broad terms of a deal to support a new oil pipeline to Canada's west coast. The reports say provincial and federal leaders are set to announce special exemptions and political support on Thursday. BC Premier David Eby has been opposing the plan. Eby told reporters on Monday that he spoke with Prime Minister Mark Carney, who told him the details were not finalized. Canadian convenience store operator Alimentation Couche-Tard posted mixed results in its latest quarter. Profit beat expectations while revenue was slightly below estimates. Revenue was driven by same-store merchandise sales growth across all of its regions in Canada, US, and Europe. The Circle K owner says its results were also helped by acquisitions despite lower fuel prices and wholesale fuel revenue. Shares of Alibaba are up in the pre-market. The Chinese e-commerce company reported stronger than expected sales in its closely watched cloud and AI arm. The domestic e-commerce arm also saw a growth of 16%. The company has accelerated the release of AI models. However, sales and marketing expenses doubled in the quarter. And now our top-line story. A bit of caution is returning after indices posted big gains on Monday. AI competition is heating up, with NVIDIA dropping in pre-market trading on a report that Meta is in talks to use Google's AI chips, known as tensor processing units, TPUs, in data centers come 2027. An agreement would help establish TPUs as an alternative to NVIDIA's chips. Let's bring in our guest co-host, Peter Hodson, Chief Investment Officer at I2I Capital Management. Peter, thanks as always for joining us.
Thank you.
Another interesting twist
Never a dull moment.
For the AI sector. Yeah. Just when we thought everything was kind of okay, now this. What kind of an impact will this have to you?
So first off, it should be no surprise that there's competition. You've got a company that owns 95% of the world market with absolutely ridiculous profit margins. So their customers have already said, we're going to develop our own chips because we have too much reliance on you. So shouldn't be a surprise. The second point is TPUs have been rented to customers from Alphabet for a long period of time, multiple years, for their own data cloud center. So this is really not a new development, but what the new development is, hey, these work so well, now we can sell them to outside customers. So Meta is in discussion, but first off, it's for a 2027 contract. So NVIDIA should be okay for at least another 13 months. But the other thing that's very interesting is Meta and Google are competitors, whereas NVIDIA is not a competitor to Meta.
Yep.
And so it gets it very interesting. It's like, so how much does your customer want to support you as a competitor? And it gets very interesting. But there are reports out there that maybe Alphabet could take 10% of NVIDIA's revenue, which next year would be $205 million. So it's a $20 billion potential windfall to Google. I'll always call it Google because I'm old.
I call it Google.
But they're massively successful, and I really do think Alphabet's going to beat NVIDIA in terms of market cap. I think it will be the largest company in the world in maybe 18 months. They spend $55 billion a year in revenue, in research and development. And this is what happens when you spend that much money, which is larger than most of the Canadian tech companies' entire market capitalization. When you spend $55 billion a year, you can come up with new products such as this. You can tweak products, you can have cost savings. So Google in itself can save maybe $50 billion in CapEx by using their own TPUs versus NVIDIA's chips. So that in itself is basically right to the bottom line. They're not giving NVIDIA a check for $60 or $55 billion. And of course, the multiple goes up because your earnings go up. Then if you can sell another $20 billion to other companies, that's a bonus as well. So there's a reason why Alphabet has gone from everybody hated it 6 months ago to now it's the leader in terms of AI processing. The Gemini 3 is just destroying the competition right now. And for now, it's free versus OpenAI, which is $200 a month for the professional level. And the difference, even OpenAI has said, like we might have a problem here because Google is just destroying the competition in terms of what they can do and what their AI can do. And now they've got a cost advantage as well using their own TPOs. So kudos to Google. I mean, they're doing all the right things.
Okay, so short term, how do investors react to this, do you think? Do they give NVIDIA space, or are we going to see over the next little while everybody going, I've got some NVIDIA stock I want to sell?
Yeah, I think you'll get a little bit of sort of worry, but much like we saw with DeepSeek and much like we saw with other issues, people panic and then they go, hey, guess what? NVIDIA is still going to have 200 billion in revenue next year, and their profit margins are 80%. It's just ridiculous. It's just a cash flow machine. Mm-hmm. And so, of course, the big question is still, even without Alphabet's TPUs, the question is always going to be, when does the spending party end?
Yeah.
I mean, right now, everybody's sold out. Everybody's scrambling. Microsoft doesn't have enough capacity for their customers on their cloud. And so that situation will last for a period of time. And some people say, okay, that's 5 years. Some people say it's 10 years. And some people say it's 2 months. So it really depends on how that spending cycle goes. But if you kind of get back down to a company level, like individual companies using AI, and this is why I still like the space in terms of the general overall market, is we really do believe that every single company in the world is going to have accelerators. Because if you don't, your competition's going to eat you alive. Yeah. And so it's just going to be something you have to do. And so that
could be almost self-fulfilling.
Absolutely. So that spending cycle could increase, and then as the usage of AI goes, with robotics and things like that, you could expand that market as well. But bottom line is, I don't think NVIDIA is going to go up 10,000% over the next 10 years like it did the last 10 years. But they generate tons of cash. They still have the highest market share. And there's now a question of speed versus cost. Some customers will want speed, and some customers will want to save costs. So it really depends on which way they're going to land. For now, NVIDIA is still far ahead in terms of capacity, speed, utilization, and they still have 2 million software developers using their CUDA software, which is using NVIDIA chips, of course. That's a nice little moat they have. But, the world changes fast, and with that money that's being spent by other companies, things may change. But I think NVIDIA is okay. It's just not going to triple in the next couple of years, probably.
Is there enough room for everybody there at the table, do you think?
For now, there is.
For now.
Yeah, and so, everyone was worried about the AI trade ending this year. But if you looked at all the companies that were reporting, basically everybody has said we are going to spend more money next year than expected. And revenue for NVIDIA, they increased their guidance, by about $3 billion or $4 billion. And so there is for now, but it really depends. You don't know how that market's going to develop. You don't know how big it's going to be. You're going to get some technical advances, just perhaps like DeepSeek, where it's like, hey, we don't need as many chips as we thought. So it's a whole sort of multiple combinations of factors that are going to happen. I think the next 12 to 18 months are kind of in the bag. Everybody's sold out. Mm-hmm. Prices are going up. Margins are high, and nobody's stopping spending. At some point, these customers are going to say, hey, we have to get a return on investment on our $100 billion that we spent over the past 3 years, but we're not there yet. They're still in the spend everything and see what happens mode versus, hey, we spent too much.
Okay. On that note, we're going to take a break, but coming up, we'll take a look at the markets before the bell. Couche-Tard reported adjusted earnings per share for the second quarter that beat the average analyst estimate, bringing in a revenue of $70.87 billion US. For more on this, let's bring back Peter Hodson, Chief Investment Officer at I2I Capital Management. Talk a little bit about Couche-Tard. Sure. And overall, I guess in line, considering everything that kind of unfolded with the M&A?
Yeah, we're pretty happy with these numbers. Obviously, they've been very distracted over the past year. We're trying to buy 7-Eleven. So now they can get rid of that idea and focus. But it really shows you what cost discipline can do, because they did miss on the top line a little bit, but their earnings were better than expected, and they had about a 2% revenue growth, but their profits rose by 4.1%. So it's a very, very well-run company with very high free cash flow. They've done great acquisitions, and it's a situation where it's like one of those sleeper stocks that's done so well over the past 20 years. And maybe it's not that exciting this year. The stock's down. But there's other excitements going on, and people are like, oh, I don't need them right now. But their time will absolutely come when the market shifts a little bit. But we've got a really interesting situation going on. So first off, in Canada, same-store sales were more than 5%, which is pretty impressive considering we're not exactly a booming economy right now. And then in the U.S., they went from last quarter was 0.4% same-store, and this quarter was 1.2%. So a tripling of same-store sales. Now, that does not sound impressive at 1.2%, but they went 7 quarters of negative same-store sales growth in the U.S.
So the room
prior to this. So just a big, big improvement in terms of what's happening in the U.S., and they've kind of refocused and they've repositioned their stores, and they're just a fabulous sort of turnaround in that situation. Then we have the company, they raised their dividend 10%. It's like, hey, guess what? We're doing okay. And the dividend's always been quite low, but now it's approaching, at least reasonably decent levels. Nothing spectacular. I think it's 1% and change. But 4 years ago, it was basically nothing. And they bought back almost $900 million worth of stock so far this year. So they're using that free cash flow. If they can't make acquisitions, they're going to buy back their own stock, and that gives them the earnings leverage, and you can see a faster acceleration than earnings versus sales. So things are going really well. We really would like to see them do an acquisition. Unfortunately, the big acquisitions are few and far between. And they are going to go global as well. So, I can't tell you who they're going to buy because I'm not familiar with the entire global world of convenience stores and gas stations. But they may go into different areas like small regional grocery stores or car wash or car detailing, things like that. They've got the locations. They've absolutely got the capital. They could do a $20 billion acquisition if they found one. But I think they'll probably do little one-offs here and there until they can get the big one.
And what are the positives of that? Maybe doing some of the smaller deals, and what are the negatives? What are the concerns? Especially, are they venturing into something they may not know when you talk about car washes, things like that?
Yeah, I mean they have some exposure there already right now. Of course, they tried to buy a big grocery store chain in France a few years ago. I wouldn't want to see them do like a giant deal, but they absolutely know the retail environment. They know the customers. They know the locations. They know the geographies. So they could certainly do a small tuck-in acquisition and just run it as a retail store. And sort of have some cross promotions and things like that. I think that would work very, very well. And then just regular tuck-in acquisitions on the convenience store. And obviously the locations can be very helpful if they ever sort of shift to a massive EV charging operation, which I think is perhaps one of the steps they need to take a little bit more aggressively.
Feels like it, yeah.
Yeah, because they have the absolute locations. They just have to utilize those a little bit better. But I don't want to fault what they've done. I mean, it's been a beautiful performer for multiple decades.
And just one more question, then we're going to move on to something, a different story. Any concerns about the fuel margins in the States? That was noted.
Yeah, they bounce up and down all over the place. Yeah, it's one of those ones where you kind of ignore the cyclicality of that. Yeah. I mean, they make money usually. Sometimes they make more, sometimes they make less. But if they can drive traffic through retail, through the fuel services, then they can sell the products elsewhere. So it just comes with the territory, that volatility.
All right, and with that fuel, we're going to segue to pipelines.
Sure.
Alberta and Ottawa, looks like they're going to have a memorandum that they may have a deal to possibly build a pipeline, but there's a lot of things surrounding it still. All of a sudden, is BC going to say yes to this? What's going to happen? What do you think about this?
Well, first of all, imagine the common sense it takes when we're rich in oil to actually send a pipeline out west to sell it to Asia. So don't get me started on that. But BC is going to have some objections. The Indigenous population may have some objections, but it does look like
Can that be smoothed over with money?
It can be probably smoothed over with agreements for other things. I don't think it's going to be like here's a big check, but it'll be kind of agreements on future projects, or maybe let them have says in future developments and things like that. But at the same time, if they get angry at this, it could block some of the future projects as well. So you have to be careful, but it absolutely makes sense. It's nice that Alberta and the feds can get along a little bit. We'll get more details, I think, on Thursday coming out of this. The details are really sketchy right now in terms of what actually is going to happen. And of course,
we haven't heard a lot on it.
Yeah, it's a pretty vague statement. And of course, a pipeline's going to take multiple years to build. So I wouldn't get too excited here, but I think it's the right step in the right direction. It has helped the fact that we have this big trade war going on with the U.S., which means guess what? There are other countries that we can trade with. If only we had a pipeline going to the West Coast.
Going to the West Coast. Is there any chance? I mean, first of all, EB, this is it could be political suicide for
it could be,
to say yes to it. Because BC is very different in its politics out there.
Exactly.
And they're very vehemently against it. So, I mean, it's going to take a lot to convince him.
It really will. But again, he doesn't have veto power on this, is my understanding. So it can proceed without BC's approval. But you want to make everybody happy. It just, that's a political game that I'm not familiar with.
And is there any chance one could go east? Could we ever see that, or is it just the distances and everything else?
It could.
Yeah,
I mean, you need the shipping, you need the ports, you need the facilities. Absolutely it could. I mean, it obviously dealing with the U.S. is a far easier, faster solution and a better solution overall. So maybe we have to wait for 3 years to get something on that side of things. But we have a vast amount of resources that are
largest in the world.
Yeah, which are being completely
Untapped.
underutilized. And when you compare it to Norway, which has got their sovereign wealth fund, and everybody's happy in Norway, it's we could be like that if we were a little bit more proactive, a little bit more investment focused. I know there's environmental and other objections, but the reality is this is our advantage, and we're not taking advantage of it.
Until we find something different.
Exactly.
And nothing is there that can truly replace it, is there?
Not yet.
The reality is not yet. It's coming. We're seeing a lot of improvements on things like that, but it is coming. And so we'll have to see what happens with it.
Yeah, it is a good step, but it's not quite, they're not quite putting the shovel in yet.
No, it may be a few years away. All right, we'll see what happens with that. And that's, of course, that oil pipeline that might be going to Canada's west coast. And up next, we'll be back with Peter to see why the Japanese yen is on his radar. Do you have a yen for it, I guess, is the question. That's up next. Time to see what's on the radar. We're back with Peter Hodson, Chief Investment Officer at I2I Capital Management, and we're going to talk about the Japanese yen and why it's on your radar. So the first question would be, why is it on your radar?
So first off, I'm not an expert in the Japanese yen, but it is something that I think investors have to watch very, very carefully. So here's the basic scenario. So for multiple years, like 10, 12, 15, 20 years, you've been able to borrow very, very cheaply in Japan. You've been able to borrow yen at effectively 0%. It bounces around 0 to 0.25, 0.5, but effectively versus other competing ways to borrow money.
That's a good deal.
It was a fabulous deal. So everyone's borrowing yen and then investing it elsewhere. And you can just invest it into the U.S. A year ago at 4%. You could buy stocks, you can do whatever, and you can arbitrage that differential where you pay 0.2% and you make 4, 5, 6%, 10% if you're lucky. And so
we call that found money.
Yeah, exactly. So that's the carry trade, and it actually is. Until something changes, it is free money because it's an arbitrage on investment returns over different regions. So every once in a while, though, there's a problem, and there's either a crisis in Japan or interest rates go up in Japan, and suddenly your free money from 0% goes to 3%, and that carry trade is completely messed up. Yeah. And you get this unwinding of positions around the globe because there's no longer free money that you're borrowing. And I'm really quite surprised that we haven't really seen much of a reaction to this because Japanese rates have spiked, and the yen is bouncing around like a yo-yo right now. And the Japanese government has a really tough decision whether they're going to support the yen or raising interest rates or let the yen sort of suffer. And then you've got the corresponding economic impacts of that, lower cost of living, higher inflation. And, neither scenario is good. You can't spike up interest rates because that has its own problem, and you can't let the yen just drift. And what are they?
It sounds like they're looking at holding the line for now, aren't they?
For now, yes, but we're not too sure how long that they can last in terms of that. But last year, like even in mid 2024, there was a bump up in the yen and the interest rates moved, and there was a big shift in North American markets. And I'm kind of surprised that no one's really caring about that right now. But maybe it's because it's going to be par for the course for now. But it's almost like a canary in the coal mine. Is if you get this massive unwinding of positions, it's going to cause a lot of volatility. Now, to be clear, it doesn't really impact the fundamentals of these companies, but it just causes a lot of selling pressure in a short period of time. So you may see some of your stocks that are billion-dollar, trillion-dollar companies take 5%, 10% hits, and you go like, what's going on? There's no news, earnings are good, blah, blah, blah. But it could be just a simple unwinding where when you have borrowed money and things change, investors tend to do very, very rapid changes because that borrowed money, of course, can kill you if you're on the wrong side.
If you're caught with it. Do we know how much is there much in Canada?
I don't believe so, but I don't have the numbers there. And the companies generally don't report how much exposure they have to the yen on a daily basis or anything like that. But absolutely, I mean, it is a global phenomenon for sure, and it's trillions and trillions of dollars at stake, and that has been borrowed and has been reinvested elsewhere. So I don't think it's something to be discounted, because if things get ugly and maybe rates spike up in Japan very quicker than expected, you absolutely will get a sell-off as people unwind these positions.
And then what happens for Japan with that money going back in now?
Well, the yen will get supported, and they'll try and reboost their economy once again. I mean, it's been a 30-year story trying to get this economy, doing something. I was actually in Japan a couple of weeks ago, and it's the cities are fine, but the countrysides are just dead. You can buy a house for $20,000.
They're giving houses away,
absolutely,
right?
But there's nobody around. Like, I was on a bike tour, and there's just like nobody. And then you go to the cities, and it's Crazyville. But they really have some issues, and part of it's population. They've hit the tipping point where the birth rate is
they have a negative birth rate. Right
they don't want to bring in a lot of immigration, and you've got this situation where I don't know how they solve that particular problem. I mean, it's a great country, but they really need to fix their economic situation for sure.
And could we see that bleeding over this way, where they're struggling? And I mean, we've had a population boom over the last while, but now we've slowed down.
It's possible, but it's a 10, 15, 20-year process.
Off topic there, but
yeah, but absolutely, countries have to plan for the future, and countries like South Korea and other countries where if the young people are not having children, there's no one supporting the future population, and of course, as we age, as we live longer, it becomes more of an issue. So a lot of countries have to sort of think about, okay, what happens in the next 100 years, as opposed to they're so focused on, how am I going to get reelected in the next year?
Yeah.
It's really sort of a systematic problem here.
Again, I'm going to bounce back just when we were talking about the yen going elsewhere. Yeah. Did we ever see that with the dollar, the Canadian dollar? Was there ever that appeal to it, or no?
No, the reason is Canadian dollar's not
we got down to a point where it was 2%, I think was a...
Yeah, but we're not liquid enough to sort of support a global carry trade where the Canadian currency is just a small piece of the pie in the terms of the global currency market. And if we had the volume of money that was borrowing Canadian dollars and investing elsewhere, I mean, they just wouldn't do it, because that unwind would be so ugly because the liquidity is not there in the currency.
Okay, we're going to leave it on that note there. But Peter, thanks as always. Still ahead, our conversation with the Chairman and Chief Executive Officer of MSCI. As well, our phone lines will open soon for our first call segment. Also 1-855-326-6266. You can send us an email as well. First call at bellmedia.ca. Multiple reports suggest Ottawa and Alberta have agreed to the broad terms of a deal to support a new oil pipeline to Canada's west coast. Provincial and federal leaders are set to announce special exemptions and political support on Thursday. CBC reporting this, citing anonymous sources. BC Premier David Eby has been opposed to the deal. Eby told reporters on Monday that he spoke with Prime Minister Carney, who told him the details were not finalized. H&R Real Estate Investment Trust is selling retail and office properties in Canada and the United States, amounting to about $1.5 billion US. The Canadian company says the step is a part of its portfolio simplification strategy. Earlier this month, H&R ended its strategic review process without a sale. It also reported operating income that missed estimates. It's trading up 0.4% right now. Shares of Zoom Communications also trading higher, up 4% in the pre-market. The American company's quarterly revenue topped estimates and sales grew more than 4%. Zoom says it is seeing strong momentum with Custom AI Companion and AI First Customer Experience Suite. Average monthly churn among individuals and small businesses dropped by nearly 3%. And let's see how things are shaping up on the markets. Looking at the futures right now, it is a mixed bag, almost a wash. Dow looking up by 0.1% roughly. NASDAQ off by 0.02, not worth mentioning. And the S&P 500 up by about 0.1%. Taking a look at the Asian markets, you can see they all ended up in the green, but relatively flat. Not bad, though, for the CSI 300, though, with the Nikkei barely up, Hang Seng up by 0.7, and the CSI 300 up by almost a percentage point, as we await news of a potential U.S. Fed rate cut. Heading to Europe, markets there, how are they looking? Let's have a look. They're not bad. They're up with the led by some banking and commodity-linked stocks. We're seeing the FTSE up by 0.4, CAC 40 by almost 0.6, and the DAX up by almost 0.7%. Where did the TSX finish the day yesterday? Another good day for it. Another big day, actually. Tech and gold stocks leading the way. It was up 1.47% and closing in on record territory again. So who are some of the movers? Let's take a look. Celestica having a big day, up 15% almost. Fortuna Mining, 10.44%. Going the other way, loss is not even too bad. 2.23% for Maple Leaf Foods, and CN Rail off by 2.3%. Taking a look at the metals, and they are up today. Gold up 1.2% roughly at nearly 4,200 again. Silver pushing back up into record territory, getting there, not quite there, 1.8%. And copper up again as well. It's been a good year for all three. It's up 2.6%. Moving over to oil, you can see a little bit of a surge going yesterday for Western Canadian Select. It's been a struggle for oil, though. It's mostly on a downward trend, but it was up 1.8%. And south of the border, WTI down again, 1.5%. It is well below 60 now, charting at under 58. MSCI creates indices, risk management products, and analytics for asset managers in both public and private markets. We sat down with the company's chairman and chief executive officer, Henry Fernandez, to discuss the trends he is observing in Canadian investors and the impact of AI on the global financial landscape.
The company as a whole is, as you describe it, an investment tools or investment infrastructure company that serves about 8,000 investment institutional clients in about 100 countries. The product that we're well known for are equity indices that measure the performance of markets. So that's about little over half of the revenues of the company. Another quarter comes from our risk management and performance platform. Another, say, 10%, 12% come from ESG and climate, and the balance from private assets.
And a fascinating story. You, I believe, took the company public about 18 years ago at a much lower stock price. Just give us a bit of history of MSCI.
Yeah, so I created the company about 30 years ago inside Morgan Stanley with two shareholders, the Capital Group of Los Angeles and Morgan Stanley, with a view to create a diversified, comprehensive investment tools company for the institutional market. So we were private inside Morgan Stanley and the Capital Group until about 17, 18 years ago. And then we separated from Morgan Stanley and the Capital Group in 2007 and took the company public, and it has been independent and public ever since.
Just looking at the stock price, over the past couple of years, it's been fairly flat. Now, I understand this is a malaise affecting data software companies, generally people uncertain about the effect of AI. Why is that, though? I mean, the shares haven't done much since 2024.
They haven't indeed, and I'm not too happy. As the largest individual investor in the company, I'm not too happy with that either. And a lot of it has been that the active asset management industry, which represents about a little less than 40% of total revenues, has continued to be an industry under significant pressure in terms of outflows, high cost structure, and consolidation. And the second headwind for us has been the ESG business. We clearly were a big beneficiary of that. But I think we are now taking major steps on reviving growth and hopefully share price by expanding into private assets, expanding into more index investing, and expanding into other client types, such as wealth managers, banks, insurance, GPs, and the like. So we're very hopeful and very optimistic that we're going to get back on a high growth. We've always been high growth, but on a higher growth path, and hopefully the share price will recover.
I want to hear about your new businesses in a second, but I'm just dead curious. The rise of ETFs must have been great for you, because an ETF needs a benchmark. What are we going to put in the darn portfolio?
Yeah, so that is, we can talk about the headwinds, but for sure, one of the major tailwinds has been index investing, especially ETFs, but also institutional passive investing or index investing. That grew about 17% year over year in the last quarter. And we now have almost $6.5 trillion our clients have $6.5 trillion in index investing directly linked to MSCI indices. So that has been a major tailwind for us, and it's been the part of the company that has been growing pretty fast.
You said this is very interesting. You talked about moving into the private equity area. I guess that's tricky, isn't it? Because by definition, these things aren't publicly posted every day. But there must be an urgent need for benchmarks in private investing, too.
Yeah, so if you're a global asset allocator, such as the Canadian pension funds, for example, they end up investing in public assets because they have transparency and liquidity. And likewise, they don't as much on the private assets because of the same, they lack transparency and liquidity. MSCI is out to change all of that. We are already providing major product lines to shed light into the transparency of all these funds. And over time, we're going to help with liquidity, not because we're going to be market makers, but because we'll be able to derive and supply valuations of the underlying holdings of these public assets, I should say these private asset class funds, so that people can create bigger secondary markets on them. So that's a big area of expansion for us.
We're very tight for time. Just tell us, are you seeing any trends among Canadian investors right now, or anything interesting in the Canadian market?
For sure, the biggest trend is what the Canadian pension funds call the total portfolio approach, which is a really next evolution of investing. Instead of focusing on individual asset classes only, focus on the entire portfolio and how you can allocate assets across the portfolio more seamless and more rapidly. And we are creating products for them.
And he was speaking with MSCI Chairman and Chief Executive Officer Henry Fernandez. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Peter Hodson is taking your questions on North American mid-caps. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. Let's take a look at some pre-market movers. For that, we're joined by Bloomberg's Divya Balji. She is the managing editor for breaking news in the Americas. And Divya, of course, we're talking about Meta, Google, and NVIDIA. What a surprise, but what a little twist we're seeing today.
Yeah, quite the three big tech companies to talk about. Essentially what we heard about yesterday was there's a report out saying that Meta is looking to spend billions of dollars purchasing Google's chips in order to help build out its AI efforts in its data centers by 2027. I think this is another notch in Google's list for how well it's been doing things. It's gotten rave reviews on its latest launch of the new Gemini model that's out there. Obviously, we also heard about Buffett building his stake in Alphabet. And then you have this piece of news. Now, if you think about it, this could potentially rival NVIDIA's Blackwell chips that are out there. From everything that we've seen with NVIDIA, this was the company that was supposed to have massive market share when it comes to AI chips. And now you see another big rival actually coming up to par with NVIDIA? I think that's the question that a lot of people have. The fact that Meta is going and signing up with Google as well puts a lot of weight behind its chips as well. So you sort of see the shift happening here, at least within the stocks today. NVIDIA is down on the news. Alphabet is up on the news. You know, Alphabet, again, has had some really good pieces of news out. Is the market shifting that way? I think that's one question as well, focusing more on Alphabet. Alphabet is also close to getting to a $4 trillion market cap that could take it above NVIDIA as well. So I think a lot of good news for Alphabet in the last day, weeks and months with everything that it's done so far when it comes to AI.
And are we hearing from any of them about anything beyond what we know?
No, not yet at the very least. You know, I think NVIDIA, you're not going to hear very much other than the fact that, you know, they are working on their own chips. You know, NVIDIA has been invested in all kinds of different AI projects. It does have the government backing. On the Google side, you know, they have talked about their TPUs. These are the chips that will be used for AI, but nothing in the sense of the tie-up between Alphabet and Meta.
Okay, Spotify. Moving up, Financial Times reporting the audio streaming company going to raise U.S. subscription prices, hopefully not Canadian prices.
Yeah, I am a little nervous about that as well. I'm an avid Spotify user, but this is a company that hasn't raised its subscription prices since mid-2024. So it is long overdue from the perspective of investors. You know, I think this, you know, the market is seeing this as a small piece of good news for Spotify. The shares are up in pre-market trading. One of the things here that an analyst was pointing out is even if it were to just increase it by $1, that could actually raise its revenues by about $400 to $500 million. So that is a huge amount that Spotify could see depending on how much they raise their prices by. Is this a good time to do it? That's really hard to say, considering how, you know, most consumers out there are complaining about rising prices and the fact that they have to pay for it. You know, are they going to spend their money on a bit of a luxury item, if we can call it that, with a Spotify subscription? I think that's something we'll have to wait and see if they actually potentially meet the $400 to $500 million in revenue if it rises by $1 in subscription prices.
All right, Divya, music is not a luxury. We need music. Okay, Bloomberg's Divya Bahalji, thank you. Still ahead, notable call. Stick around. All right, let's take a look at some of the notable analyst calls and recommendations leading up to Canadian bank earnings next week. Our first notable call is from Jefferies analyst John Aiken. He has cut the recommendation on Royal Bank to hold from buy. His price target is now set to $2.15, a 1.7% increase from the last price. Aiken also cut the recommendation on Toronto Dominion to hold from buy with a price target of $125, implying a 7.1% increase from last price. Meanwhile, Raymond James initiated coverage of RBC with a recommendation of outperform. The price target was set at $229, implying a 8.3% increase from last price. And Raymond James also initiated coverage of CIBC with a recommendation of market perform and a price target of $127, and also initiated coverage of the Bank of Nova Scotia with a recommendation of outperform, a price target $108. A Manitoba school division is asking teachers to reduce the number of homework assignments they give out due to the use of AI by students. CTV's Alex Carpa has more.
A consistent classroom trend has emerged among students over the last few years.
We noticed that the students were having problems with homeworks.
Alain Laberge believes AI and other online tools have played a role in this shift. The school division he works for recently issued new guidelines for teachers, recommending that homework be assigned in moderation while encouraging students to read on their downtime at night.
We have not forbid homework. What we're telling them is the easiest thing and one of the best thing is to read.
Laberge believes AI is impacting how students complete their homework.
They would just simply turn around and ask AI questions and just write down the answers, which we believe is not really useful. It's not the way, it's not critical thinking.
Teachers are being asked to be careful of the types of homework they give out to ensure AI isn't being used as a copying tool. Michael Holden believes it makes sense not to be grading work that is being sent home with students.
When I send homework home, I don't know if the student did that on their own or if they had help from a parent or from a sibling or a tutor, or plugging it into Google or plugging it into a chatbot and asking it to answer the questions for them.
Other professors like David Gerhard say finding a balance is important.
Finding some way to allow students to learn the power of these tools, but also learn how to do the material themselves is going to be the balance.
We're not trying to demonize AI. That's not what we want parents to understand. It's just like AI and homework is not necessarily a good combination.
For LaBerge, he says he just wants to see students succeed and is confident this policy will keep them on the right path. Alex Carpa, CTV News, Winnipeg.
And when we come back, Peter Hodson takes your questions on First Call. Time for First Call and, of course, first email as well. We'll start there today. And this one's from John. Can Peter comment on Maple Leaf Foods? Excuse me. I was getting hungry there. Is it a good buy for a long-term hold, 4 to 6 years for a dividend investor? What's a good entry point?
Sure. I'm not going to give an entry point because this market bounces around too much. I mean, basically, at our shop, you either buy it or you want to own it or you don't own it. That's the decision you need to make. So Maple Leaf, it's not an exciting story at all, but they did their spin out of their pork division. It's relatively low valuation. The dividend's okay. It's very safe. It's one of those names for the next market event or the next market cycle. I don't think it's going to get a lot of attention while AI and tech are flying, but when there's a slowdown in the economy, it's one that you want to keep. So I'm glad that the viewer was saying 4 to 6 years because I think that's probably the appropriate time frame for this. So nothing exciting, but nothing wrong either. So it's just a nice little solid company.
Yeah, sometimes that's not a bad thing, is it?
Boring is not bad ever in the investment world. It really isn't. I mean, unfortunately, everyone's so short-term focused. It's like, what'd you do for me this quarter? But slow and steady cash flow, there's nothing wrong with that at all.
Okay. This email is from Dean. I am wondering about your thoughts of NFI Group in the near to mid-future because of backlogs and battery recall. Are they still a hold or a buy?
Sure. This is a company that's had massive kind of financial issues and they had to restructure some of their debt. They've always had too much debt. It's a bus manufacturer. It's one of those ones where it's a cyclical play and it's a higher risk play. So when things work perfectly, the stock will do very well. But there's a lot of risk here still. They've had a lot of issues. We believe in the cockroach theory, where there's one problem, there's more problems. And so it's just one of those ones I wouldn't
become the meme, hasn't it?
Yeah, I wouldn't be entirely comfortable with it as we go into perhaps an economic slowdown going forward. So I think it's one to watch and one for the future, but I think it's higher risk right now.
Okay. Let's get to the phones. And Daryl from Nanaimo, BC, what's your question?
Yes, good morning. Thank you for taking my call. My question is about ARC Resources. Last week or so, I've noticed a trading pattern that concerns me. Right at the end of the day, huge volumes of shares force the price down. Yesterday, it dropped it by 20 cents a share. Can you tell me what's going on? Thank you very much. I'll hang up and listen to your response.
All right, thank you very much, Darryl.
I mean, there's companies, if insiders are trading or if there's company more than 10%, they have to report their transactions. But what's really happening here is they have what's called market at close orders, where an investor is trading a position throughout the day and they haven't filled it through the day. And so at the close, usually like literally at 4 o'clock, massive amounts of shares go down so they can get their average price that their client wants. So I wouldn't really read too much into that. It's very, very common. There'll be lots of bouncing around at the end of the day on pretty much any liquid stock. So I would take a wider view in terms of ARC. So it's a nice little, or it's not that little anymore, but it's a decent energy producer. Their last quarter wasn't perfect, but that's reflected in the valuation. It's a very low valued stock. It could be a takeover target for someone else, and as long as they can get their production back online and keep growing production, they can't control their costs. Obviously, the commodities bounce up and down, and right now energy is not really anybody's favorite right now with oil declining, but it's priced well. And so it's one of those situations, it's a cyclical name. I think if you buy it 5 years, you'll be happy you owned it, pays a dividend. And I would not focus on the day-to-day trading. I mean, stuff happens during the day that there could be 100 explanations for that, none of which you can prove. So just look at the fundamentals over a longer period of time. You'll be much happier, and you'll have more time to look at other companies because you're not focusing too much on the short term.
So there's no conspiracy theory?
Not that I know of.
I'm disappointed. All right, let's get back to the emails now. Umesh, I would like Peter's thoughts on how to best play the growing nuclear renaissance. And that is a good word because it does feel like it's getting there. Atkins, Realis, Cameco, Sprott, Physical Uranium Trust, and GE Vernova are all on my radar, as is diversified. I am not speaking English this morning. Diversified Approach and THX.
Sure. I mean, you can always buy a combination. If you want to play the nuclear play, you can have a couple of these companies and you probably do okay. I think the trend is good. I do believe in the sector. There's going to be a massive amount of spending towards the nuclear sector. It is the best solution. Everyone can argue with me, but they'll be wrong on that. But
it feels like it's looking like.
Yeah, a couple of years ago, I wouldn't have put Cameco in that list. Cameco has always got, they sell their contracts forward and they never really get the spot prices on uranium because they've sold lower prices to capture that forward price. But last year, they did a deal with Brookfield on Westinghouse. And now Westinghouse is a big developer of nuclear. And the US government has specifically said, you know what, we're going to give you, I don't know the exact number off the top of my head, but it was like multiple contracts over the next 10 to 15 years. And now I think Cameco is absolutely one of the more interesting plays there that you can go. Atkins is a developer of sites. It's an E&P company that builds these. Pretty good company. You'll be okay.
All right, we got to cut it off there.
All
But
right.
okay, one I can think we can do. Oh, it took a nap. Fairfax, buy or hold?
It's a buy. It's a value stock. Yep.
Done. We're going to leave it on that. Peter,
All right.
thanks as always for joining us. Peter Hodson, Chief Investment Officer, I2I Capital Investments. That is that it for us on the streets. I'm going to go take some speaking lessons. And Andy's up next with the Open. Have a great day.